Welcome to Geoscope. Our mission is to connect the dots, tracing global economic and political currents back to the communities they impact. We break down the pivotal shifts reshaping industries and redefining our future, following the story from corporate boardrooms to the factory floors of the industrial heartland. Today, our focus is on a name synonymous with America itself, John Deere. For nearly 2 centuries, its signature green and yellow machinery has symbolized agricultural prowess and industrial might. It's more than a company, it's a cultural icon, woven into the fabric of the American heartland. From the first steel plow that broke the prairie soil to the GPS-guided combines harvesting our food today, Deere has been a titan of innovation and a cornerstone of American manufacturing, a brand generations have trusted. But now, this icon is at a crossroads. After a legacy spanning 185 years, deeply rooted in American soil, the company is making a significant pivot. John Deere is scaling back key manufacturing operations in the United States, specifically within its historic production facilities in the Midwest. The destination for this new chapter of production is Mexico. It's a strategic move the company frames as necessary for its long-term health, but one that sends a seismic shock through the communities that have built their lives and identities around these factories. So what's driving this monumental shift? It's not one single factor, but a perfect storm of economic pressures. The company points to a complex web of challenges: soaring costs for raw materials like steel, persistent supply chain disruptions, and intense pressure to maximize profits in a fiercely competitive global market. Add to this the unpredictable landscape of international trade, a battleground of tariffs and geopolitical tensions. For Deere, the calculus has become brutally simple. The cost of doing business in the U.S. is rising, and the relentless search for efficiency has led them south of the border. The fallout is immediate and far-reaching. It's a story of quieted factory floors in towns where generations have proudly worn the Deere logo. It's a story of economic anxiety rippling through small businesses that depend on the factory's ecosystem. And it's a political firestorm in Washington, reigniting fierce debates over trade policy, corporate responsibility, and the future of American jobs. In this episode, we unpack this pivotal moment. How did a company so deeply American reach this decision? What is truly at stake for the workers, the towns, and the nation's industrial base? And we ask the fundamental question: what is the future of Made in America? For over a century, the name John Deere has been more than just a brand. It's been a cornerstone of American agriculture, a symbol of strength and reliability passed down through generations. The iconic green and yellow machinery represents a promise of progress, deeply woven into the nation's identity. But the bedrock of this American icon is showing deep fractures. The years 2024 and 2025 have marked a dramatic and unsettling pivot, forcing a painful reevaluation of its future and its commitment to the heartland. The first tremors were felt across the Midwest, as the company announced a series of strategic closures and workforce reductions. Hundreds of skilled manufacturing jobs were eliminated, hollowing out communities that have depended on Deere for decades. These aren't just numbers on a spreadsheet, they represent families facing uncertainty and the erosion of a way of life. The financial picture tells an equally stark story. A staggering 18% drop in equipment sales in the second quarter alone sent shockwaves through the industry, with forecasts predicting a continued downward trend. The decline is fueled by a perfect storm of economic pressures. First, soaring interest rates have made financing a $500,000 combine or tractor prohibitively expensive for many independent farmers. Second, a global glut of key commodities has driven crop prices to multi-year lows, squeezing profit margins to the breaking point. With less cash on hand and expensive credit, farmers are forced to delay major capital investments, choosing instead to patch up old machinery and wait for better days. In response, Deere is making a controversial strategic move. By 2026, the company intends to shift the entire production line for its compact and utility loaders to a new state-of-the-art plant in Mexico. From a corporate perspective, the logic is clear: access to lower labor costs and a more streamlined supply chain for growing Latin American markets. It's a textbook case of globalized efficiency, designed to protect the bottom line. However, the decision has ignited a political firestorm. The White House, under President Trump, has condemned the move as a betrayal of American workers. Trump has publicly threatened to impose steep, targeted tariffs on all equipment imported from Deere's Mexican facilities. vowing to use economic force to keep manufacturing jobs on U.S. soil. This places John Deere at the center of a complex dilemma, caught between the demands of Wall Street for profitability and the pressures from Washington to prioritize domestic employment, a high-stakes battle with no easy answers. Trade disputes are compounding Deere's struggles. Tariffs have already cost the company $100 million this quarter, with $500 million in potential losses projected for 2025. Construction and forestry divisions, closely tied to global markets, are feeling the pinch. Deere is pursuing tariff relief under the USMCA and adjusting its global production strategy, but customers should expect price hikes of 2–4% on 2026 equipment as the company tries to offset these costs. Behind the numbers are families and towns hit by layoffs. More than 1,800 Iowans have lost jobs since 2020, including nearly 300 this year alone. Local leaders are pressing for companies that cut jobs to return state tax credits, while Deere says market realities, not broken promises, drive its restructuring. For communities that have long depended on Deere's payrolls, empty storefronts and shrinking optimism tell a deeper story. Farmers, Deere's core customers, face their own squeeze. High borrowing costs, weak crop prices, and retaliatory tariffs are pressuring profits. Many are holding on to older machines instead of upgrading, straining dealerships and creating parts shortages. Repair delays add to frustrations, and the uncertainty weighs on rural economies as well as Deere's bottom line. Despite turbulence, Deere is investing heavily in its U.S. footprint, pledging $20 billion over the next decade. Plans include modernizing aging factories, adding new production lines in Iowa and Missouri, and opening an excavator plant in North Carolina. Success, though, hinges on more than spending. The company must rebuild trust and prove it remains a reliable partner to America's farmers. Beyond tariffs and layoffs lies another hurdle: supply chain instability. Semiconductor shortages, higher steel prices, and shipping bottlenecks have stretched delivery times by months. Deere is reworking supplier networks and joining federal logistics initiatives to reduce delays, but the stakes remain high for farmers and contractors who depend on timely shipments. John Deere stands at a critical crossroads, where its industrial legacy meets the digital age. The recent job cuts and offshoring are not isolated decisions, they are symptoms of pressure from a volatile global economy. Fluctuating commodity prices and high borrowing costs have cooled the market for agricultural equipment, forcing short-term austerity. Yet, simultaneously, the company is placing massive long-term bets on a future defined not by horsepower, but by processing power. These investments in autonomy, AI, and precision agriculture are designed to secure its dominance for the next generation, creating a stark contrast between immediate pain and a visionary, albeit uncertain, future. This strategic pivot attempts to redefine the company's identity, from a machinery manufacturer to an agricultural technology firm. The goal is an integrated ecosystem where smart tractors and data analytics promise farmers unprecedented efficiency. This tech-first approach, however, is a high-stakes gamble. It requires farmers to embrace new, often subscription-based models, raising complex questions about data ownership, the right to repair, and the escalating cost of innovation. If this bet pays off, Deere could become an indispensable partner in modern farming. But if farmers resist, or if competitors offer more open solutions, the company could find itself alienated from its core customer base. For the workers, farmers, and towns bound to Deere's legacy, the coming years will test their resilience. The nature of a Deere job is changing. As some manufacturing roles move overseas, new positions in software and robotics are created in the U.S., leading to a skills gap and a painful adjustment for communities built around the factory floor. This forces a re-examination of what "Made in America" means. Is it about the final assembly, the origin of the steel, or the intellectual property and software that brings the machine to life? The answer is no longer simple. The path John Deere is forging is fraught with both promise and peril. So we turn the question to you. Is this strategic pivot a necessary evolution for an American icon to survive in the 21st century? Or does it risk severing the deep-rooted community ties that defined its legacy? Will the pursuit of a high-tech future ultimately benefit the American farmer and worker, or are the global headwinds and internal contradictions too strong to overcome? We want to hear your perspective. Share your detailed thoughts in the comments below. And for more clear, in-depth explorations of the critical stories shaping our industries and communities, don't forget to subscribe to Geoscope.